July the 13th, 2023. Before sunrise, federal agents arrested Alex Mashinsky. For years, he had been one of the biggest names in cryptocurrency, a charismatic entrepreneur who told millions of people they no longer needed banks. Instead, they could trust Celsius Network, a platform that promised to make crypto work for everyone. Customers deposited Bitcoin, Ethereum, and billions of dollars worth of digital assets, believing their money was secure. At its peak, Celsius managed billions of dollars in customer funds. But behind the confident interviews, the weekly live streams, and the promises of financial freedom, federal prosecutors would later allege a very different story. One involving misleading statements, high-risk investments, and billions of dollars that customers suddenly couldn't access. So, how did one of crypto's fastest-growing companies collapse in a matter of weeks? And why did the man who promised to unbank the world end up facing federal criminal charges?
The story begins. In 2017, Alex Mashinsky launched Celsius Network with an ambitious goal: to reinvent banking using cryptocurrency. The company's message was simple. Traditional banks kept the profits. Celsius claimed it would share those profits with its customers. Instead of earning a fraction of a percent in a savings account, users could deposit their cryptocurrency and receive annual returns that sometimes reached double digits. To many investors, it sounded revolutionary. Mashinsky became the face of the company. He appeared on podcasts, spoke at conferences, hosted weekly live streams, and consistently portrayed Celsius as a safer, more transparent alternative to the traditional financial system. As cryptocurrency exploded in popularity, millions of people searched for ways to earn passive income. For many, Celsius looked like the future of finance. But beneath the rapid growth, the company was taking risks that many customers never fully understood.
Between 2020 and 2021, the crypto market experienced an extraordinary boom. Bitcoin reached record highs, Ethereum surged, and digital assets captured headlines around the world. Celsius grew alongside the market. Customers transferred billions of dollars onto the platform, attracted by high interest rates and reassured by Mashinsky's repeated promises that customer assets were protected. Every week, thousands tuned in to his live Ask Mashinsky Anything sessions. He answered questions directly, projected confidence, and described Celsius as fundamentally different from traditional financial institutions. The message resonated. By late 2021, the company reported managing tens of billions of dollars in customer assets. To supporters, Celsius represented the future of banking, a financial system without banks, without unnecessary fees, and without Wall Street. But every success story depends on one thing: trust. And trust can disappear much faster than it's built.
As cryptocurrency prices began to fall, the first warning signs appeared. Analysts started asking difficult questions. How was Celsius generating such unusually high returns? Were those yields sustainable, or were they built on increasingly risky strategies? Some researchers questioned whether the company had enough liquid assets to withstand a major market downturn. Then, the unthinkable happened. In June 2022, Celsius suddenly announced that it was pausing all customer withdrawals, transfers, and swaps. The company cited what it called extreme market conditions. For millions of customers, the impact was immediate. Their accounts were frozen, their savings locked inside the platform. Some had invested their retirement funds, others their entire life savings. Panic spread across the crypto community. Confidence collapsed almost overnight. Customers demanded answers. Regulators began asking tougher questions. And investigators started examining whether Celsius's public assurances matched what was happening behind closed doors. What they uncovered would become one of the most significant crypto fraud investigations in American history.
Once customer withdrawals were frozen, the questions came quickly. Where had the money gone? And more importantly, had customers been told the whole truth? Federal investigators, including the Department of Justice, the Securities and Exchange Commission, the Commodity Futures Trading Commission, and the Federal Trade Commission, all launched investigations into Celsius Network. Investigators began piecing together millions of pages of documents, internal emails, financial records, customer communications, and public statements made by Alex Mashinsky himself. They compared what customers had been told with what was allegedly happening behind the scenes. According to prosecutors, Celsius had publicly described itself as a safe place to store crypto. But investigators alleged the company was taking on far greater risks than many customers realized. They also examined whether Mashinsky had misrepresented the company's financial condition while continuing to encourage customers to deposit even more cryptocurrency. Then, another discovery raised even more questions. Federal prosecutors alleged that while customers were being encouraged to hold their assets on the platform, Mashinsky had personally sold tens of millions of dollars worth of his own CEL tokens. That allegation became one of the central issues in the government's case.
The investigation wasn't simply about a failed crypto company. Markets rise, markets fall. Businesses sometimes collapse. But prosecutors argued this case was different. According to the indictment, the government alleged that Celsius had presented itself as a safer alternative to banks, while concealing significant financial risks. Prosecutors also alleged that Mashinsky repeatedly made misleading public statements about the company's stability, even as Celsius faced mounting financial pressure. Mashinsky has pleaded not guilty to the criminal charges. The allegations remain subject to the judicial process. But for customers, the damage had already been done. When confidence disappeared, so did access to billions of dollars in customer assets. Almost overnight, one of crypto's biggest success stories became one of its biggest failures. On July 13, 2023, Alex Mashinsky was arrested. The Department of Justice announced criminal charges, including securities fraud, commodities fraud, and wire fraud. On the same day, multiple federal regulators filed parallel civil actions. The legal pressure was overwhelming. Months earlier, Celsius had filed for Chapter 11 bankruptcy protection. Court filings revealed the enormous financial hole facing the company and the difficult road ahead for customers hoping to recover their assets. The bankruptcy process would continue for months as courts worked through billions of dollars in claims. For many customers, the collapse wasn't just a financial loss, it was a deeply personal one. Some had trusted Celsius with retirement savings. Others had invested money meant for a home, their children's education, or years of hard-earned savings. The collapse of Celsius became another defining moment in the crypto industry's turbulent history. It intensified calls for stronger oversight, greater transparency, and clearer rules for companies managing customer assets. It also reminded investors that high returns often come with high risks, especially when those returns depend on strategies customers cannot see. The Celsius story isn't just about cryptocurrency. It's about trust, the promises companies make, the questions investors choose not to ask, and the consequences when confidence replaces careful scrutiny. Innovation can reshape industries, but transparency, accountability, and honesty are what make innovation sustainable. Because in finance, as in life, if something sounds too good to be true, it deserves a closer look. And sometimes the biggest risk is believing the promise without understanding the reality.